Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Alconin, along with Dennis Dick. And we have Dave Lauer on the line. He's a president and managing partner of Core Trading Group, along with his partner, Christopher Nagy, founder and CEO of Core Group. Good morning to you, gentlemen.
Good morning, Joel.
Good morning. Thanks for having us on.
How's it going here, guys? Dennis Dick here. I want to start with this whole thing from last week. BAT's potentially coming out and saying they're going to back off some of the illiquid stocks. So in this comment letter, they're going to come out and they're going to say that they're going to suggest that some of these illiquid stocks only trade on their primary markets. I'm suspecting that is because, and I've argued this for a while, if you go back 10, 12, 15 years ago, majority of stocks, New York stocks, trade on New York. And if you look at the liquidity, it's very fragmented now. We've talked about this in the market with you guys multiple times, where you got 12 different exchanges. You've got a lot of off-exchange trading happening too, and trades kind of happening all over the place. Well, when you have illiquid stocks, they're obviously only trading, or they're trading a lot less volume to begin with. And then when you fragment that lower liquidity, it's kind of hard for buyer to meet seller. So I kind of agree with this potential proposal. What are your thoughts here? We'll start with you, Chris. What are your thoughts here on this BAT's proposal? And do you think this would help the liquidity issues in the small caps?
Yeah, Dennis, I actually do. I think it's an interesting proposal in terms of kind of bringing back the liquidity to a central place. Now, you brought up the old NYSE Rule 390, which was back in the 90s and beyond, which prevented off-exchange trading. But that rule dealt with a lot of the larger issues as well, too. So, and what we saw is, as Rule 390 came down, the larger issues migrated away, and we saw volume grow in that, but we didn't necessarily see the benefit to the smaller stocks. So by reaggregating volume on the less liquid names, it could go a long way into centralizing liquidity in that regard. So I'm a proponent of what BATS is doing. I've been really impressed with Chris Concannon, the new CEO, just stepped in, who's actually worked at a high-frequency trading firm, Virtu, and then prior to that was head of transaction services at NASDAQ and did a lot there. So I'm very encouraged to see some of the progress here.
Do you think this is potentially a better solution than the tick size pilot here, which is going to come out? Because they've been talking about addressing this for a while here, and they're potentially going to raise the tick size on some of the small caps to a nickel to try to encourage liquidity providers. Dave, what are your thoughts? Is this a better solution than the tick size pilot, or is this something that should work along with the tick size pilot?
You know, it's an interesting proposal. It's an interesting question. And, you know, to be frank, at first I was a fan of it, and the more I think about it, the more I don't want to say skeptical, but I kind of see both sides of the argument on it a little more clearly.
Okay.
I think it can be dangerous for the SEC to come in and say, you know, here's a set of symbols that can only trade on the listing exchange. Now, it may be worth a pilot, and in that way, I think it could be a potentially more interesting pilot than the tick size pilot. And I do think that, you know, it just simply remains to be seen whether it could have a more beneficial impact than, let's say, a well-structured Trade Act rule, for example. But I do have concerns around, you know, what it could mean for competition and whether it's the right idea or not. You know, I don't like the fragmentation, but I also think that we don't necessarily need regulatory intervention here. You could simply have the exchanges stand up and say, well, this is a good idea, we're going to do it unilaterally or voluntarily. And, you know, given that they tend not to do something like that, at least maybe consider it as a pilot. I don't know. Again, it's a pretty substantial change. As Chris was alluding to with 390, you know, there were some significant impacts to that rule that led to it being, you know, taken away due to questions about competition and fairness. And, you know, we have to be very careful as this, you know, pendulum kind of swings back and forth. We don't want to go too far back to what we had before.
Do you think the other exchanges follow suit on this? Like this is just BATS talking here now. Do you think some of the other exchanges are going to follow suit on this? I think that's what BATS is hoping for.
You know, They might if here's the interesting wrinkle. I think maybe if this isn't necessarily an altruistic move by bats, if maybe they stand to save some money, especially given their high rebate fee structure in some of these less liquid names. Maybe there are other exchanges out there that also will recognize that and see the trade-off similar to bats. And they don't have the same kind of fee structures, but they might recognize an opportunity to kind of stand up and lead on market structure at very low cost, because there can't be a lot of revenue coming in from these names anyway.
Now, we haven't seen the actual proposal here. Okay, go ahead, Chris. Yeah.
Oh, I was just going to say, I think one of the downsides of this is I don't think you'll see other exchanges follow suit. And I think the NASDAQ test on the lower maker-taker rates in the market, so NASDAQ put out a test where they lowered the rebate and the take structure in the marketplace. None of the other exchanges followed suit on that.
Yeah.
The exchanges generally... Yeah, and the exchanges generally compete very, very strongly with each other. So, in that regard, my question is, what does BATS want out of it? So I think they want to go down the road of ETFs and being able to exclusively list some ETFs in exchange for giving up some of the other names.
Right.
So what happens in a scenario then when some of these names become very active and could actually trade on a different exchange for the benefit? And selfishly thinking, maybe not selfishly thinking, but how does that then benefit investors when you've got a very active name and it only trades on one exchange? What's going to happen. The costs are going to go up in that situation.
It's a really important point, I think, actually, that Chris is making in terms of hoping others will follow suit. And, he brings up the low access fee pilot. There was a really interesting filing by BATS this past month. We track all of the SRO filings every month. We summarize them and comment on them for our subscribers. And the BATS filing, basically in the BATS rulebook, they are able to charge for venues that they route orders to, or they're able to return in order routing the lowest possible rebate in the fee book, regardless of whether that's the actual rebate that they're receiving from the venue that they're routing orders to. And so they just dropped their NASDAQ rebate, I think it was at 15 mils, down to 4. So any orders that you send to BATS to route, and you end up resting on NASDAQ, you're only going to get 4 mils, even though it's only 14 names that applies to out of the thousands that you'd be trading. So, there's definitely cutthroat competition at, kind of every step of the way.
Just one more point about this, but wouldn't, if you move all these stocks to one exchange, wouldn't it simplify it a little bit? I mean, we're talking access fees. A lot of our listeners here, it's very hard for a retail investor to understand this market structure. It's very hard for a professional trader to understand this market structure here. And by simplifying it and dropping it down to, one exchange for these, smaller illiquid stocks, don't you like the simpler model, though? Chris? Dave, whoever.
Yeah, simple is simple is good. But to your point, we actually do market structure workshops for the government as well too. So I think even the government has some issues in getting their hands around market structure. Simple's good, but we live in a complicated and complex environment. So it's not as simple as just saying, we're going to, stop listing these and life is going to be simple and everyone's going to get a better shake in the deal. It's much, much more complicated than that. When you look at the various fee structures, the characteristics of various securities and how they trade. You guys were talking about a host of them today, like Netflix, for example. How those stocks trade are different. How Netflix trades is very different than how Bank of America trades, and how Citigroup traded before the split. So when you simply, say, we're going to do this and all problems are solved, I think it's wishful thinking in that regard, knowing that we live in a very complex structure.
Yeah, and Chris, it's important to know complexity is not always bad, and of course, we're always advocating for simplification of market structure. But some complexity can be good. It can, it can increase resilience in the market. If the listing venue were to go down, today you could still trade those names on any one of 11 other venues, but if it was only the listing venue listing them, then suddenly you'd be out of luck to trade those names if there was a problem at the listing venue. It doesn't mean there need to be 11 or 12 other exchanges, but having a couple in there does help in terms of system resilience, and it does help in terms of competition. You have to be wary of what fee structures might result. And I would just say my opinion is simply still reserved. I think it's an interesting proposal, and I'd like to see a test, because I don't think you can roll out wholesale market structure changes in such a complex environment without piloting and seeing what the data says first.
Do they have a date on the tick size pilot yet there, Dave? Have they actually come out with a date on this, or is this just kind of, they just keep talking about it, but I haven't seen an actual date where this is going to start?
It was supposed to be May 6th. I think that's what they pushed it off to.
Okay.
And I don't know that
That's
means
right.
they're going to actually start it on the 6th. But I know the SROs are building that functionality right now. They're probably testing it. So it should be coming up pretty soon. That's our understanding.
Yeah, the SEC is supposed to issue the final rule proposal. May 6th or May 9th is the date. So we'll probably see a rollout, I'm guessing, by the end of the year in terms of the tick pilot.
And then they'll have to pick. And did they finalize it with 1,200 different securities, or do we know what the actual numbers of securities was in that final proposal here?
Well, that's what we're going to find out with the final proposal.
Right. So once
they don't even know if they're going to maintain the same structure. A lot of comment letters, including ours, were critical of the structure that they had put in there and the way they had grouped and the number of groups. And again, talking about complexity versus simplification, we argued they should they should really simplify it. Get rid of groups 1 and 3. That the trade-out rule that they had constructed was going to lead to a dramatic increase in unnecessary complexity and needed to be rethought. And we thought that things just needed to be simplified there.
Yeah, you had some concerns with the one exemption that was for off-exchange market makers there, where if the tick size is wide on some of these pilots, they can still actually match the quotation there, and that's just going to lead to more off-exchange trading. Chris, you started talking about that just at the beginning of the interview. Can you just go into a little bit more depth in there on why that's a concern?
Yeah, well, one of the big exemptions is the retail exemption, which would still really allow internalization in the last bucket we call the number 4 bucket. And so essentially, if you're a retail trader and you trade these stocks, you can get a minimal amount of price improvement and you see the internalized, but you don't see the full benefits of it. So it's what's happened, unfortunately, with this entire tick size pilot is politics and special interests have really gotten in the way, and we're seeing a much watered down version that is caveating to a lot of special interest groups. So the terms of a real test on this, I don't think we're going to get much out of it. There's not going to be a lot of stocks. There's not a lot of volume in these stocks. I don't think we're going to learn a lot. I certainly don't think it's going to be the be-all and end-all benefit that Congress was seeking in terms of bringing liquidity for small-cap stocks back to the markets. I just don't think we're going to see that out of this pilot, regardless of how the final version comes out.
Dave, just what are your thoughts here? I just want to just continue on the disclosure stuff, because I know you guys have a core group have talked about the 605 and 606 reports, maybe improving disclosures there. What disclosures need to be improved there, and how some of these orders are handled off exchange?
We think it's pretty straightforward, frankly. Disclosures at the moment, they exclude trade sizes or parent order sizes more than 10,000 shares. We think that we just need to get rid of that. We think that everything needs to be made much more explicit in terms of the data feeds that are being used to calculate some of these numbers. We need to make sure that there's no gaming going on between direct feeds and the SIP. And we need to make sure no order types are excluded. When it comes down to it, those are the broad brushstrokes of the changes that we think need to be made. You've had all these exotic order types created in the market, and that's just served to reduce the amount of disclosure in terms of order routing and order execution quality. So, change those 3 things and then modernize some of the metrics. So instead of measuring if an execution happened between 0 and 9 seconds, which is of course all of them. Break it down to microseconds and milliseconds, and let's get a real picture of what's going on these venues. And again, these are changes we proposed over a year ago now. They're totally uncontroversial. There's nobody that disagrees with them, and yet, unfortunately, it's very slow progress. I think one major disappointment, going back to the good-hearted nature of the exchanges, is that, as I said in my Senate testimony last year, there's no reason that you need regulatory intervention for exchanges to start putting out better metrics on execution quality, and to have ATSs do the same thing. You don't need the SEC to step in a heavy-handed way. These SROs who are supposed to be looking out for fair and efficient markets can simply say, yes, this is the right thing to do. We'll just go do it because it's easy and it's very valuable. But, of course, nobody has done that. So Chris and I have formed a nonprofit called Healthy Markets. We've talked about this before, and we're using that to push these kinds of changes. And we're hoping to work with the industry to actually get the industry to move on some of these ideas without requiring regulatory intervention.
We've been on the line with Dave Lauer. He's president and managing director of Core Trading Group, LLC, and Chris Nagy, founder and CEO of Core Group, LLC, giving us their take on market structure. Thanks a lot, gentlemen. Great conversation as always. We'll speak to you again soon.
Yeah, thanks,
guys.
Thanks, guys.